In late 2018, Andrew Left posted this tweet, broadcasting to the world that his firm was investing in Tesla stock. And that was a factually accurate statement for a couple of seconds. Within just 1 minute of sending that tweet, he was selling large chunks of his Tesla position. And the following day, he dumped 81% of his remaining shares. His tweet and the analysis report he released at the same time drove Tesla stock up 13% that day, making Left an $8 million profit. In the report, he wrote that by no means does Citron only trade on published stories. An incredibly ironic statement, given he was later charged with 17 counts of securities fraud for doing exactly that.
News about short seller Andrew Left. He is in hot water at this hour. The Securities and Exchange Commission charged him and his company with multiple counts of securities fraud.
What they're calling alleged bait and switch tactics.
He faces up to 25 years in prison.
And we intend to hold Left and his firm accountable for their actions.
That trial just concluded. After 2 days of deliberations, the 12 jurors delivered a verdict that shocked Wall Street. I've never in my life spent this much time reading court documents, but it's all worth it so that I can show you the incredible paper trail of tweets, text messages, fake invoices, and my personal favorite, lies caught on live TV. But let's start with a simple text message. Candy from a baby. It's August 2018, and Andrew Left reaches out to a portfolio manager at a Toronto hedge fund called Anson Advisors. His opening message, "I have a hot voice in cannabis. Let's take advantage of it." The two start discussing going short on Cronos Group, a Canadian cannabis company whose stock had been surging in price. Do we go long on Redacted or short Cron? We can destroy Cron. Left is a prominent figure in the investment world. He'd been running a platform called stocklemon.com since 2001, publishing short reports on companies he believed were fraudulent or overvalued.
Cronos is a great short. That stock's going to like $2.
Around 2007, he rebranded the site to Citron Research and developed a powerful reputation for correctly identifying companies that would become the subject of regulatory investigations and lawsuits. So that August 2018 message was the absolute truth. Left had the ability to collapse a stock's price with the press of a button. Sonny Puri, the Anson portfolio manager, followed through on their plan by sending Left a draft short report with a price target of $3.50. The report had the Citron Research letterhead because Andrew Left was going to publish it as if it was his own independent research. On the morning of August 29th, Left began building a short position equivalent to nearly 1 million shares of exposure, a combination of equity shorts, put options, and short calls. The stock was trading at roughly $16.50, and the next morning, he published the report.
Marijuana stocks have been melting up this year, but pot names came under pressure today after noted short seller Citron Research made a bearish call on Cronos Group.
The stock was decimated, down almost 30% by market close. Andrew Left then appeared on CNBC to further explain his view that Cronos stock had another 70% decline to go. Now, as we watch this interview, I want you to keep something in mind. Left has already closed 61% of the investment. He's mostly out. In fact, within 30 minutes of releasing his short report, he was already trading in the opposite direction to his recommendation.
And I have to ask you this right off the bat. Are you still short Cronos right now, or did you cover?
Oh, I'm definitely still short the stock, no doubt.
Okay.
But first of all, Melissa.
Okay,
First
Andrew.
of all, why do I have to be infamous? Can't I just be famous one day? Or just Andrew Left? But that's okay.
Well known. Whatever you want, yeah.
Okay, there you go.
That question is not going to age well. But anyway, Left says that he still has his short bet on, which is technically true, but you can actually see in Melissa Lee's face that she isn't buying it, which is why she asks a more precise question.
You're short, you say you remain short. When did you put that short on, and will you take that short down to 350?
Oh, I don't, come on, Melissa, you always ask that question, and it's irrelevant when I put it on or when I'm going to take it off. What's relevant is the information
here's what's
that's in the
relevant.
report.
Here's what's relevant to people watching. Are you just as short the stock right now as you were at the beginning of the day?
I took a small size of the position off today. Yes.
Okay.
But I'm still extremely short this stock.
The next morning, Left sent a private message to Sonny Puri. Now that I know who owns Cronstock, candy from a baby. That's what he thought about the people who had taken his recommendation, the many thousands of retail investors following his Twitter. Candy from a baby. Now, I think this is pretty egregious, but at this point, I wasn't exactly convinced that any of this was actually a crime. And I certainly was confused as to how it escalated to 17 fraud charges, each carrying a 20-year maximum sentence. So you'd be justified in thinking that this is all free speech, protected by the First Amendment. Especially since his answers have all been half-truths, no flat-out lies. But I was wrong. It gets so much worse. Also, put your food down for a second and consider hitting the subscribe button so my very infrequent uploads appear on your homepage recommendations. On the morning of November 20th, 2018, Left emails a portfolio manager. Do you want to make some fast money? Put together a thesis for why Nvidia is oversold. Less than 90 minutes later, he had built a long position in Nvidia. At 10:17 in the morning, he tweets, "Citron buys Nvidia. This is the first time in 2 years the stock offers an appealing risk reward to investors. We see 165 before we see 120. Nvidia stock jumped on the news, and within a few hours, Left had sold 100% of his pre-tweet position. He made approximately $930,000 profit in less than 2 hours. Exactly 1 month later, Left builds a short position in Twitter and buys put options expiring the next day. The cheapest and riskiest kind, because nobody expected the stock to dramatically move within 24 hours. But Left, of course, knew that the stock would collapse because he was going to cause it. At 9:52 in the morning, he published a short report labeling Twitter as the Harvey Weinstein of social media.
Well, the significance is the attention it's receiving, in particular from Citron, which has a reputation for going after companies and successfully having sort of an activist position on them. And so that's one reason the stock is reacting so much, because we've seen...
Left closed his entire short position before the day ended, a $2 million trade. That afternoon, in a private message to his business associate, he said, "I feel like I want blood. Made some money today on the short side, $2 million trade in Twitter. Love the title, Harvey Weinstein of social media." Just 6 days after that, Left opens a long position in Facebook. The tweet and report he released immediately after label it as the stock of the year. As crazy as it sounds, when I put out big reports on big companies like this in the middle of the day, what I'm really doing is switching algorithms, he said privately to an associate. Left is talking about trading algorithms, all those automated bots that trade instantly in reaction to company news. He'd realized that Citron Research had become so notorious for making a stock price move that there were computers programmed to buy or sell as soon as he tweeted. Within 6 hours of the tweet, Left had sold 89% of his Facebook position, profiting at least $680,000. Around this time, he launched a hedge fund called Citron Capital. Left told Reuters that he'd been generating an annualized return of nearly 90% for over 10 years, and he now planned on raising a few $100 million from outside investors. In July the next year, Citron Capital published a letter addressing his hedge fund investors, boasting a 36.6% return in the last 6 months. Another investor letter showed he made 56% in 2019, and another revealed a 202% return in 2020. But that all came to a disastrous end in 2021. Left went short GameStop, which probably goes down in history as the biggest L ever taken by short-selling hedge funds. On the 21st of January, he posted this YouTube video.
Hey, this is Andrew Left at Citron Research, giving you 5 reasons why GameStop is going to $20. As long as the borrow is available and insiders are still selling and the company needs money, you won't see a squeeze from here on in. Number 2, numbers don't lie.
Let's just say that the stock did not go down to $20.
The so-called Reddit rebellion is putting hedge funds in a position they don't often find themselves in. Every day this week, I hear about several more funds that are suffering significant losses as a result of volatility in names like GameStop. In some cases, it's changing the way hedge funds do business.
When the squeeze happened, GameStop hit nearly $500 per share, and Left lost approximately $7 million.
After being squeezed in GameStop, his firm known as Citron is switching gears.
As of today, Citron Research will no longer be publishing what can be considered as short-selling reports.
He received death threats. His children's personal information was posted online, and so he decided to quit the short-selling game. Well, that's what was reported in the news, at least. We now know there was another reason that may have contributed to his decision. That same week, the SEC began issuing Left with subpoenas. When investigators started pulling Left's trading records, the first thing they noted wasn't any single trade, it was the pattern he repeated over and over again. It looked something like this. The timeline of events for each trade had two distinct layers. The public world was the things like Andrew Left's tweets, and then there was a private world happening below the surface. Let's look at another one of Left's trades, XL Fleet. On the 23rd of December 2020, at around 1 PM, Left buys approximately 500,000 shares of XL Fleet. The stock at the time is about $25 a share. At 1:37 PM, he places a limit order to sell his shares the moment XL hits $27.50. That's his exit price. He sets it before a single person outside of his brokerage knows anything is coming. At 1:41 PM, he tweets, "Citron long XL, target of $60, just 4 minutes after placing the sell order. Within one trading day, XL's stock moved, the limit order is triggered, and Left walks away with $2.7 million. This is the architecture of every single trade. Build a position in a stock, set an order to exit the position, all before he's told anyone about it. Then publish a report with an extreme price target, so it garners wide media coverage and a sharp price movement." Well, actually, the DOJ's investigation uncovered one extra step in Left's strategy. Between September and December 2018, Left received more than $1 million from Anson Advisors, the Toronto hedge fund where Sonny Puri worked. This was payment for getting advance knowledge of upcoming Citron publications, which of course allowed Anson to trade ahead of the price movements Left was about to trigger. To hide the payments, Left routed the money through a third-party intermediary using fake invoices. This unnamed third party would invoice Anson for research services, Anson would wire them the money, and then Left would invoice the third party for consulting services, and the money would be wired to his accounts. A total of $1.1 million in fabricated fees. And it wasn't just Anson. Left had a similar arrangement with another unnamed hedge fund, which also paid him more than $1 million. Left having these arrangements makes the Harry Markopolos situation so much funnier. A quick bit of context, Harry Markopolos is a fraud investigator. He's known for warning the SEC about Bernie Madoff almost 10 years before his Ponzi scheme was exposed. In 2019, Markopolos published a report claiming General Electric had a $38 billion accounting fraud. Shortly after, Andrew Left published a counter-report attacking Markopolos. He wrote, "Markopolos is being paid a percentage of profits from an unnamed hedge fund that is short GE. No credible hedge fund or short seller would ever do this." He went on to say, "In 18 years of publishing, we have never been compensated by a third party to publish research. More important, compensation tied to the success of a trade would not pass internal compliance, nor would it pass compliance of any fund that Citron would collaborate on ideas with." That is basically an exact description of himself. There is actually a truthful statement here. He's right, no credible hedge fund would ever do that, including his own. Remember those Citron Capital investor letters I showed you earlier, detailing their hedge fund's annual performance? Investigators looked into those too. Turns out his hedge fund had no outside investors. None. Left was simply trading his own money through an entity that looked like a hedge fund. The investor letters were fabricated. He didn't send them to any investors because there were no investors.
In an ironic twist of the story, Andrew himself has now been charged with both an SEC civil case as well as a criminal indictment where he faces up to 25 years in prison for market manipulation.
In July 2024, a grand jury indicted Andrew Left. 17 counts of securities fraud, 1 count of engaging in a securities fraud scheme, and 1 count of making false statements to federal investigators. Well, that false statements charge was eventually dismissed, but that's not the last we'll hear about it. In fact, it's not an exaggeration to say that the dismissed charge accidentally holds the fate of the entire trial. But we'll get to that. The trial opened on May 11th, 2026, and lasted for 15 days. The prosecution was first to present their case. They put a number of retail investors on the stand to testify about their investment losses that were caused by the release of Citron short reports. The aim was to show the jury that Left's commentary was considered important in deciding whether to buy or sell a stock, one of the elements for proving a securities fraud charge. The prosecution then played clips of a podcast with Left that was recorded the day after his Kronos short.
Kronos is a great short. That stock's going to like $2. So I'll keep shorting that one. And I can tell you just from getting all the emails that I got on it yesterday, it's all retail investors who have no business to be in the stock market, honestly.
The prosecution argued that Left specifically targeted stocks that had high levels of retail investors because he knew his reports were more likely to influence them.
When you look at the other side, and by seeing who's in it, if you see who's known as quote-unquote these smart guys in it, it makes you double and triple check your homework, if you're short it.
That he knew that unsophisticated investors would trade based on his tweets alone without even reading his reports.
Stocks move so fast, that you have to first trade the stock and then read the report. So it's kind of like screwed up,
Then of course came all of the private communications. In one exchange, Left described being a tweet away from hitting their end-of-year target of $21 million. The prosecution's expert witnesses quantified the market impact. Citron publications moved stocks by an average of about 12% per report, and the trading records showed the same pattern across 15 companies and 5 years. The prosecution's case rested on a simple idea, that Left knew exactly when a price would move because he was the one moving it. And then he exited while his followers held on waiting for the price target that he never intended on reaching. As a part of his defense, Left decided to take the stand and tell his own version of events. His position was basically that there's no law against trading after you publish a report. There's no specific period of time, I believe, you have to hold a position after you make a comment, he said. When his lawyer asked him whether he'd ever been long a stock while publicly trashing it, Left said never. Had he short a stock when publicly praising it? No. And asked whether he believed everything he ever wrote, he said, "It's the stock market. I say what I believe. I speak truth. If people want to read it, read it." Then came the cross-examination, and it was kind of a disaster for Left. Prosecutor Ben Boulding showed numerous text messages, emails, and video clips of Left boasting about his ability to move a stock and profit from it. But most importantly, the prosecutor showed the jury that Left lied about nearly everything. Playing a podcast clip of him saying, "My investors don't pay me to be right, they pay me to make money. That's my directive from my investors." And then showing the jury that he never had any investors. He just wanted to appear more legitimate to the world. But the most consequential moment of the trial may not have involved testimony at all. Instead, the jury instructions. The judge explained that the law does not impose a general duty to a market commentator to disclose their trading positions or intentions when they publish investment commentary. That part validated Left's argument. His lawyers had argued this for 2 years, and the judge agreed. But then she continued. When a statement is a half-truth, when it affirmatively represents something material while omitting critical qualifying information, a duty to disclose arises. Left's defense largely rested on the idea that he had never explicitly lied about the direction of his positions, but saying you've only covered a small size of a short position when you've actually covered 61% of it, to a lot of people that might be considered a half-truth. The 12 jurors would deliberate the 17 counts of fraud over the course of 2 days. On the 1st of June, they returned their verdict sheet to Judge Phillips. As she examined the jury's decision, she discovered a mistake. The verdict sheet had 18 charges on it, not 17. Count 18, making false statements to federal investigators, was a charge that had been dropped before the trial even began. The jury must have accidentally been given an older version of the verdict sheet. Even weirder, the 12 jurors had unanimously ticked guilty for a charge that prosecutors didn't even present arguments for.
A federal jury has convicted prominent short seller Andrew Left of securities fraud. Prosecutors accused him of using his reputation and media appearances to manipulate shares in a way that would reward his trades.
Andrew Left was found guilty of 13 counts, including the more serious securities fraud scheme charge, the one that carries a maximum sentence of 25 years in prison. Now, this is where I had planned on ending the video. Sentencing isn't happening until August. But then this just happened. Andrew Left has filed a motion for mistrial, and it has everything to do with the verdict sheet mistake. And in particular, the fact that the jury ticked guilty to a charge they knew nothing about. Left's lawyers said in a statement that a jury that would return a guilty verdict on a charge that no one explained to it speaks for itself about the reliability of this verdict. Which to me is honestly a pretty compelling argument. At the very least, I would want to know exactly how it happened. Did the jurors discuss the 18th count and find him guilty, or did they just tick it by accident? But we probably won't get answers to those questions because the law protects jurors from being accused of providing unreliable verdicts. And actually, the motion for mistrial was just rejected as I was about to upload this video, although Left still has chances to argue for one at a later date. But the judge effectively said that she was confident the jury understood the issues presented and were not misled by the clerical error. Ultimately, I guess he should have just generated a better lawyer with AI like this guy.
May it please the court. I come here today a humble pro se before a panel of—
Shut that off!
Click this playlist if you'd like another deep dive video to watch, and your battery's getting low. Go plug in your charger. So dumb.